Good afternoon, everyone. It's 3 p.m., and we are delighted to welcome you to another insightful session on connecting the dots. First and foremost, our heartfelt thanks to our esteemed speakers for joining us today and contributing their valuable perspectives to this panel discussion. Ms. Muskan Agarwal, Treasury at Zapto, Mr. Sanjay Patni, Associate Director and National Head Institutional Sales at Mirai Asset Managers India Private Limited, and Mr. Anil Suneja, CFO India at India Medtronic. We are truly honored to have such accomplished leaders with us, bringing their expertise and insights to this discussion. To know more about our speakers, you may follow them on LinkedIn. The links are shared in the chat window. Mr. Aditya Hegde, who was also part of this panel, had an unavoidable office commitment and couldn't join us today. Now, on behalf of HRAI, I also extend a warm welcome to our participants to this session on the impactful topic balancing short term goals with long term financial planning. For more information about HRAI, please visit the links shared in the chat window. It's now my pleasure to introduce today's moderator, Mr. Anil, who will be guiding us through this discussion with his deep insights and expertise. Over to you, Mr. Anil.
Thank you, Faisal. Good afternoon, everyone. You know, Warren Buffett once said, someone sitting in the shade today because someone planted a tree long time ago. And I love that line because it captures the essence of what long-term planning truly means. It's about having that courage to invest, to build, to nurture, even when the world around us is obsessed with the short-term achievement or quarterly outcome. Every organization today wants growth, innovation, sustainability. But the truth is, we all are balancing two ticking clocks. One, the short-term pressure of delivery, and the second one is long-term responsibility of direction and strategic implementation. And that's the fine line we'll explore today. Our leaders, like us, make decisions that drive immediate result without compromising the future. So again, good afternoon, everyone. It's my absolute pleasure to be here with the HR leaders as well as the finance leader. Now, HR and finance, I think that partnership determines a lot in the organization. Um, One which truly, while finance looks into the numbers and execution and show the barometer of the performance, HR leaders like all of you make sure that we have those talent resources who execute to deliver on those performances there. So over the next half an hour or so, we'll go beyond the theory, talk about real world leadership, the trade-off, the tough calls, the clarity needed to balance today's win with tomorrow's goal. Now, each of our panelists, as you heard from Faisal, both Sanjay and Muskan has led through volatility, whether it is market shocks, transformation, cost pressure, and they have their own stories of transformation and learning words from. So I'll be inviting them to share not what they just did, but how they did that and how they thought through those two moments, the reasoning, the data, the conviction, which helped them to balance short-term goals with the long-term financial planning. And for the HR leaders on the call, I'll invite you to listen through the lens of partnership, the lens of leadership. Because as I said earlier, when finance and HR align on the long-term agenda, it's about capability investment, it's about culture, it's about sustainable growth. So with that background, maybe let's get going. Sanjay, let me start with you first. Sure. We all operate in an environment today where the focus is on short-term delivery, what we can do quickly, how can we translate those efforts which the organization is doing in quick results. And short-term results matter a lot. What's your perspective on balancing short term goals with the long term financial planning, and especially when the medium term often seems to disappear from sight?
Sure. Good afternoon, everyone, and thanks, Anil, for setting the tone. Uh, because when you look at this topic, it's very close to our heart. Because being in financial markets for last 2.5 decades or so, it's always put you in spot all the time because the expectation management in these periods becomes very difficult. And as you rightly mentioned, Anil, because uh, expectation of delivery, quarterly delivery, having pat in place, etc. All that always puts pressure on all the leaders. And obviously, cumulatively, you always try to take the safeguard. And at times, in my view, you take the safer bet rather than taking the aggressive bet, actually. Sticking out neck is not a phenomena which is much instituted by executives. Obviously, that's natural human psyche. But uh, firstly, let me tell you, it's extremely important lesson which we learned over our life by making definitely some mistakes, no doubt about it, because not everybody gets to learn so easily, and definitely taking some good decisions by learning those matter. You mentioned last thing was the medium term. A lot of times people look at short term and a long term. I always love the medium term space as well, which you mentioned, and thanks for mentioning that because that becomes a critical part. So for us, I think all the three have huge and significant role to play in financial planning for sure. Let me try and break into maybe three parts. Uh, when you look at financial planning, I think the first is short term, maybe. And I always believe, and I think I've been propagating, teaching, and all that. I think liquidity management is first and foremost, which is extremely important for anyone to look at. And that's important, most important part. And I've seen most of the people who do not know how to manage liquidity, they actually unnaturally die. And I'm not saying literally, but obviously they get succumbed to pressure points. It's extremely important to plan for those short term expenses. Very importantly, to note down, plan, and execute that. Very important. And when I look at many people today in short term, uh, when I speak to many people, they jump straight away to investments, mutual funds, stock markets, and all that. There's so much of buzz around us, all of us. We always look at that, to be honest with you. In my view, that's an incorrect view. In my view, first thing first, you should go to safeguard and risk management first, which maybe have a term insurance first in place. Maybe have a PPF or a VPF in place. Try and ask HR to have additional deduction of VPF. That adds to your short-term goals. And then definitely have a Mediclaim in place because I'm sure all of us know the earlier you buy a Mediclaim, your actually premium drops and it's a lifelong renewal you can have. So I think in my view, first thing, short term, I think these are important parameters. Once you have done that, then you move to your investment cycle. Till this time, I was talking about how to monitor that. Now, let me move to the medium term part of it. When I'm saying medium term, I'm saying regular inflows are very important. People actually miss out by locking in everything. It's important to have that, which also leads to stability of income because when you need money, it should be available to you. In mutual fund language, we always talk about systematic withdrawal plans. SWPs are available to people to consider that there are hybrid schemes and all the way you can do that. Dividend income is another part. One should invest and look at those high dividend yielding investment opportunities, which can always add a lot of value to in a medium term cycle. Uh, Investment outflows, which gets locked in, is very important not to miss out. Very important to plan that. And that portion will become illiquid, doesn't matter. It's important to have education planning in mind because I'm sure today's education expenses are really, really high. And I'm sure all of us experience it. And that is actually going out of the roof. Family vacations in medium term, well, you cannot live without. I always learn from day one that 30% of expense should be saved, but 30% should always be spent on family every year. Doesn't matter, irrespective of that's where it comes from. And you should always on a medium term ready for unforeseen circumstances and expenses because something like medical or otherwise, I have gone through myself, so I can understand that very well. And I'm sure all of us experience that. Now let me move to the third part, which is the long term. I know I'm taking slightly longer answer, but I'm still trying to put some perspective here because that's important for people to understand that long term for me is NPS. It's important to have a financial planning in place. People should learn, invest, and wait for uh, you know, income which is permanent in life. I'm sure worldwide we see CalPERS and all that we have seen regular income after the retirement also. I think that's where India has grown now. PPF and VPF, that becomes a long-term investments. Real estate is extremely important for one to plan. In my view, the real time you plan it, it actually helps. That's a long-term investments. Mutual funds to me, a lot of people talk about trading. In my view, mutual fund is a long-term investment. I am always proponent of saying that lump sum or SIP, irrespective, look at next decade or so, not below that. And once you do that, I'm sure you're going to be advantageous at always advantage at kids' wedding for sure and education. I think these are long-term planning, which are unavoidable completely. I'm sure some of the expenses which I spoke about, maybe which will also say that some of them will remain regular, but some of them will be long-term investments for sure. That's important. Uh, I've also seen, Anil, I must mention that there is a stark difference between all three, short, medium, and long. But a lot of people mistake in differentiating between the three, and they actually do a blunder out of it. They plan for long term, but monitor in short term. That's becomes the most dangerous part of it. Let me also put maybe the last thing. Of course, you look at from analogy point of view, look at in the parlance of cricket, and more specifically, look at a one-day 50-over cricket match, which I'm sure all of us have watched over a long period of time. In a classic example, where in short term, if you look at that, one has to learn to hold the crease first 10 to 15 overs, continue to make runs, let the tick box the runs on board. Maybe at an average of 6 7 runs you per over, you continue to do in first 10 15 overs. Then next 25 overs, I think, it's become the medium terms phase. Check the loose balls, look for gaps to make runs, hit boundaries or sixes as per opportunity. Irrespective whether you lose a couple of wickets also in that period, doesn't matter. Then you plan for long term actually. That's where you come to move the last phase of 10 12 overs, where if you haven't lost too many wickets, if you are not in a trouble in that period, you can put a decent score by taking huge risks. You can actually go all berserk and hit really hard to put up a challenging score. If you actually look at short term, medium term, and long term, this is a classic story where actually compounding, if you really saves your time and a big role to play. Earlier you start the planning, obviously, you're bound to mistake that. You're bound to win the real battle. If I were to look at youngsters today, maybe the last line, if I would definitely want to mention that they pile up liabilities first, then they think of assets. And I think, in my view, that's the most dangerous part. So learning short term, medium term, and long term, not by buying iPhone, but buying an investment asset is more important. Back to you.
No, great, Sanjay. I think your analogy of cricket is something which I'm sure everyone would have resonated with. And clearly, I think one line which you mentioned that, it's important to define what short term, medium term, and long term is. And you mentioned that many of time we make mistakes. We plan for long term, but monitor in short term and take our decisions accordingly. That's one key takeaway. As the leaders on the call, we need to see that are we doing enough um, uh, in our uh, in our personal life in terms of planning for that long-term medium as well as in the organization. I think as leaders, our responsibility is to see things coming up and plan ahead of time for that. So thanks for sharing that perspective, Sanjay.
Oh, thank
Maybe
you.
Muskan, I'll come to you now. In Zepto, one of the things which I'm sure you must be doing, long-term plan always look great on paper, but when it comes to execution, it's about people. It's about how you get that strategy executed from people. Workforce planning, in many ways, is the human side of the long-term financial planning. How do you see the partnership playing out in your organization, especially when it comes to automation, reskilling, building the next generation of the leaders?
Yeah. Thank you so much, Anil, and good afternoon, everyone. I would like to start the conversation by putting a food for thought for everybody over here and all the listeners that financial balance isn't about, choosing between your today or tomorrow. It's about making sure your today's choices make your tomorrow better. So, I mean, that's kind of a crisp of what a financial balance looks like. And now, coming to your question, that's a really relevant question, Anil. Because today, workflows planning and long term financial planning are no longer two separate conversations. At Zepto, we look at them as completely integrated. So, whenever we plan for the future, whether it's automation, you mentioned reskilling, or leadership capability building, finance and HR work together from day one. Now, it is not a separate forum that it's a HR job or it's a finance job, right? Automation, for example, isn't just a cost decision for us. We look at the full picture, what efficiency it brings in, how it changes our cost structure, but also how it impacts our roles, skills, and the long term capability. So I think instead of viewing automation as a way to cut cost, we see it as a way to reallocate resources so that it can freeing up the bandwidth for the higher value work and reinvesting that part to the reskilling programs. So this ensures our people to evolve with the business rather than being left behind by it. So that is the whole idea when what how we run workforce management with the long term financial balance. And also we also run here in Zepto joint workforce financial reviews, and that is also happens on regular intervals, where we do assess the ROI of the talent decisions, not just in terms of salary cost or maybe productivity, but in terms of leadership pipelines, what their readiness, what is their retention and engagement as well. So I think in the end, it's all about balance completely. Financial planning gives structure and gives discipline, while workflows planning brings in agility and foresight. So when both the functions aligns, you are not optimizing for today, but you are actually building the kind of organization that can sustain growth for next 5-10 years down the line. Yeah.
Well, thanks for sharing that, Muskan. I think clearly one takeaway in what you mentioned is the fact that investing in our people in the organization is a long-term investment as well. You secure your long-term and
Yeah.
medium term by investing in people to make sure that they are with you and they are equally excited to deliver on the strategy which finance may be deciding in terms with the organization growth and way forward. So thanks for sharing that perspective.
Right.
Maybe
Thank you.
Sanjay, I'll come back to you. You know, you do this day in, day out. I mean, you are in the whole, equity space and you deal with investors, right?
Mhm.
You deal with organizations investing. So, investors are really unpredictable. And in a bull market, they expect growth. In a bear market, they demand resilience. They're always demanding, whether it's growth, profitability, or resilience.
Yeah.
How do you keep calm, consistent, and grounded through these cycles, and make sure that financial planning stays steady? How do you plan for that?
Sure. I thought you were about to say that in bull and bear both they expect the growth. So I was wondering that, but that's fine with me. I was actually wondering that you'll come there, but good to hear that for sure. Resilience. No, so absolutely. I mean, being part of the markets for long and working along with investors for decently long period of time now, I think first thing people have to learn, financial planning is done by keeping horizon in mind, investment horizon in mind. It's very important to have risk appetite defined, because each individual, depending on the age, depending on their appetite, the risk appetite changes, obviously. Uh, of course, people have to look at their asset class in mind, no doubt about it, because there are multiple abundant products available today. In last, say, 25, 30 years, we have already seen that thanks to regulators, across the regulators, we have seen multiple products got evolved in each asset class, which is a good part of it. Obviously, that helped us to keep on evolving. I'm sure you mentioned, Muskan mentioned about planning, disruption, technology advancement, and all that. I think that's what we are talking about. Now, be it fixed income, be it equity, maybe be it hybrid assets, maybe gold, silver, maybe real estate, and sometimes at Forex also. I think some asset class aren't supposed to be touched, first of all. And most of the people mistake, they look at all the investments as they get tempted, because when the returns are generated, you actually start to look at the temptations start to trickle down. And that's where one has to learn some asset class, some investment they're not supposed to touch, even if heaven falls, like real estate or a gold or a PPF, VPF, or even medical insurance should not be touched. There is no doubt. So first thing first, people have to understand the first lesson is irrespective of cycle, bull or bear, this should not be done. Number one, markets will always behave differently. They will go up, they will come down in cycles, and I'm sure all of us have seen in our experiences. Uh, any industry, any segment, there is no industry or segment which can say I am growing perpetually. That never happens for sure. So we have seen those cycles. Generally, we say 8 years is an economic cycle of bull or a bear run. We always see that, and that's what we have seen also. Uh, like you mentioned about equity market, nobody can predict, and nobody shall try to, in my view. But that's the most important part. Sticking to basic investment fundamentals, I think, will always make you remain calm and composed. I've seen why people panic. Um, they lose their sleep because of the diagram of Nifty. Okay, that's what it happens with people. While think about this way, if you bought a particular share or invested in a mutual fund scheme, then market cycle shouldn't bother you, as over a long term it will compound and it'll average out for sure. We learned spelling of compounding long back. We learned this averaging out long back, and that's actually helped us. Now look at this way, I'm sure you're a part of corporate world like all of us. uh, in a nominal GDP cycle, you're talking about say 10-11% of GDP growth, with around 6.5% of GDP growth, with 4-5% of inflation. I think top 100, companies are continuing to grow at 100, maybe 100, 10 to 11%, sorry. Also, with income in the hands of people growing, the liquidity in the hands are increasing thanks to the departments, regulatory departments, etc., helping us to reduce GST, reducing taxation. Up to 12, 13 lakh rupees of income has become tax-free and all that, which means that consumption cycle is only growing, which means if that grows, your growth is inevitable. If there is a possibility that the growth will not get hampered in the in general period, irrespective of intermittent period, you will always see a slump. But irrespective, that can keep you patient for sure as an investor. Now, if you weighed the risk of each asset class separately, you divided that and maintained the discipline of investing in regularly. I think discipline and regular investment, I think these are two behavior which I mentioned earlier as well. Anyone and everyone will remain at peace. Secondly, if the investments, see, generally we all of us invest regularly. Investments are done by all of us in a manner that it is contingent saving, which means that if money is always available for families' needs, irrespective of exit loads, penalties, charges, etc., it shall remain available all the time. If that is there, I think half the time you will always be at calm or composed. Number one, whether directly or it should be leveraged. You should have an opportunity to leverage it in the market. Whether it's institutions, banks, NBFCs, they always provide you the liquidity against it. I always tell the investors, I said, if your ECG is not normal, equity market is not for you. Okay, that's important part of for any investment behavior. If that, as long as that is there, you should just stay calm, enjoy yourself over a longer period of time. I think we have always seen markets have delivered. You look at a 7-year, 10-year rolling cycle, markets have always delivered, and that's delivered 2.5% more than any fixed income product, if I were to mention that. So in my view, I think it's always good to remain at peace, resilient, irrespective. Interest rate will go up, they will come down. Equity market will go up, it will come down, but finally it'll go up for sure. Yeah.
So thanks, Sanjay. I think the way you position equity and ECG together, and I come from a healthcare background, you come from an equity background,
Okay.
so we can easily resonate with each other on that. But I think the key
Sure.
takeaway which I take on what you mentioned is, the power of that diversification of the asset class, the power of being disciplined in your investment, the power of being perseverance. I think persistence matters. You can't
Yeah.
just think short term. You have to see that how you can think more medium and long term. I think that is something which I take as a takeaway, which helps to kind of like balance the expectation of the investor, both in short term as well as when it's a bull or a bear market there. So thanks for sharing that perspective.
Sure. Thank you.
Also,
All
I
right.
think, Anil, just to
Yeah.
add over here, I think patience is the only key to earn in any kind of a market, whether it's a bull market or a bear market. Being too, bullish as well and being too bearish as well will not amount to any kind of profits or losses. It's just the patience, what makes you win in the market, actually, either on the either side.
Yeah.
Actually, if you actually realize it, when you speak to so many youngsters today, when I visit corporates, when we try and meet so many millennials, I think they are always talking about equities. They're talking about stocks specific. They're talking about Bitcoin and asset classes which are like volatile. Now, once you lose money, it actually shakes your confidence, unfortunately. And that actually gives you a bitter experience or a bad experience. And that's where Muskan is also talking about. Have patience on a longer period of time. The perseverance actually make you win the battle. And finally, over 10 years, it gets averaged out. I mean, even if you make
Yeah.
3 days, 40% return, it gets averaged out actually.
And I think, tasting the loss as well is very much important in this market, as Sanjay has mentioned. So, a lot of youngsters or millennials, they have just tasted after COVID, they have just tasted, the highs in the market. They have never tasted the low. That is also a very big problem for the longer run, right? So, it's equally good to have some losses in the portfolio so that to make better capital gains.
The last 1 year, Nifty is flat. So good, they're learning it.
Yeah, of course.
It's all about positioning those learning, right? Those losses as learnings. It's important.
Yeah.
But just to build on that
True.
one, that persistence, patience, it's not always measurable in numbers, right? I mean, you can't just measure that if somebody had remained in that asset class for longer, they did the better financial planning. So maybe Muskan, this sets a right segue to the next question which I have for you. We all love numbers, and um, what are the key matrices and indicators which help you to assess whether you are striking a right balance between short-term performance and the long-term sustainability? And on top of that, how do you make those visible and actionable for your teams, for your stakeholders? How do you do that?
I mean, that's a very important question, Anil. And honestly, trust me, it is one of the toughest balances to maintain, truly. At Zepto, we literally look at this through as a financial lens as well and a strategic lens as well. On the short-term side, if you'll ask me, we monitor the basics very closely. Things like our cash flow efficiency, our working capital cycles, our contribution margins, and the high factor, the burn rate. This give us a pulse on, how the efficiently we are operating day to day and how agile we are in responding to the business cycle. But alongside that, we are equally focused on long-term sustainability metrics as well. Zepto is a 4-year-old startup. I mean, which is no more a startup, feels like a corporate. But yeah, it's a 4-year-old company. So sustainability is a bigger question mark over above anything, right? So the long-term sustainability metrics like our profit trajectory, how our cost to revenue ratio is, how our return on invested capital falls on, and beyond. Many other matrices. And beyond financials, we also track softer but equally critical indicators like our employee productivity, because employee cost in a startup is usually very much high. So it's very important to be cognizant of that fact as well. Then your capability development, our leadership pipeline readiness, and even the innovation metrics as well. Like how much of our spend is going into automation or process improvement, because that is the major USP what a quick commerce right now holds. So the idea is to make this parameter very much visible to all the key stakeholders, may it be finance or business or the HR or the growth partners or the process partners. So through we all try to do this through a common dashboards, which share the visibility to the multiple stakeholders, which creates the alignment and accountability between the teams. So if we see short-term performance improving, but talent attrition or innovation investment dipping, it's an early signal to act. This is a very, I think, a very important point to focus on. So for us, it's not just about numbers, it's about reading the story those numbers tell and making sure we are building a company that's efficient today and resilient for tomorrow. And I think that's how a startup can grow and be sustainable in this market.
No, that's a very interesting perspective, Muskan. And I think it's all about defining the right set of KPI, which balance between the short term and the long term. I mean,
Yeah.
I think this is one thing which I can say. Like, often there are pressure on expenses, and we have to take hard call on expenses. But cutting expenses doesn't mean that you are burning fat. Sometimes you burn bones as well, right?
Hmm.
So that's an important element that as leaders we have to keep a balance on what sort of KPI we are monitoring. And I think you mentioned very aptly, are we growing today, but at the same time our attrition is significantly higher? We're burning at the cost of, we're growing at the cost of mid to long term. So this
Yeah.
KPI makes a lot of difference there. Sanjay, any
No,
perspective after
so let
that? Yeah,
me let
go
me
on.
let me add, Anil. I'm sure I completely concur with what Muskan mentioned, and I think one of the biggest thing, and she mentioned startup, and it's a corporate now, obviously 4 years old, but uh, I worked with so many relationships on institutional side. There are corporates we have seen who have done exceedingly well. They plateau, and some of them don't plateau. They actually dive southward, and the reason is, I think their sustainability model, sustainable growth model, constantly under gets under question. And I think that is where I think a corporate to corporate makes a difference. We have seen at least 500 startups must have shut down in last many years, last 5, 10 years maybe. But there are many who have actually grown, like they've gone to be part of even Nifty today, right? Or a top 100 companies maybe. The difference between them is, I think men and boys got differentiated. They actually worked on sustainable business model, and I completely agree with what Muskan is mentioning, because that becomes the most important part. If you're taking the right calls, uh, keeping that in mind, that uh, balancing between growth and inflation, both sides for sure. So that's important part, obviously. Yep.
Yeah. Thanks for adding that perspective, Sanjay. And maybe switching gears, Sanjay, and you know, at this point of time, India is considered as a growth engine for the world growth, with a lot of structural reform being done. But yeah, I mean, there have been years when things have not been really well, and if as a country we're not doing well, majority of the sector also start to see the impact of that. So when business cycle get tough, and which they always do in many cases, how do you keep your team motivated around the long-term story? Because there's a natural anxiety which comes across. Couple of great years in terms of a 10-15% growth, and suddenly a policy change happened, or an broader implication which came across the organization from an economic perspective, puts the growth trajectory differently. So how do you motivate your team, and what is the playbook for communicating that confidence with clarity when it comes to people who are dealing with short-term pressure?
Uh, No, it's an interesting perspective, because after seeing maybe three economic cycles today, when you look back today, you actually realize that what you're mentioning is so true and so apt. And we have faced ourselves and gone through ourselves, not only with teams, but you have seen yourself. Uh, I think when we look back, started career in 99, then look at 2003, then 2008, then 13, then 17, then 20, and now when we look at that, I think these are the 5 points or 6 points. When you look at, you actually realize many things have gone past by. In my view, at every step, each person wants to understand what is in it for me. If I stay put, what is in it for me? That becomes important. So when I talked about finance and HR and the organization, I think, and once you're convinced about it, I think no reason for anyone not to believe you, not to remain resilient and continue to remain calm and composed, because uh, it shakes your confidence. I mean, there's no doubt about it. When market drops 50% or 40%, obviously it puts a lot of pressure on the corporate, for your investments, for your vertical, everything goes out of cost. Uh, in my view, when I was uh, an individual team member, and then has grown as a team leader over a long period of time. I think his journey is more important than the outcome. In my view, when I was an individual contributor as well over a long period, uh, our seniors used to communicate to us and say that, hey, the markets have gone down in 2004, 2008, and all that. Uh, and I still remember, I can tell you that 2004 to 2008, it was a skyrocketing market bull run. I'm sure you'll remember, Anil, when every day, every quarter, they had 25% return absolute were coming to your investment portfolio. Now, was it sustainable? Our answer was no. You're making money. That doesn't mean sustainable for a long time. 2008, and then you drop from 21,500 of Nifty to say 6,500, 7,000. And then you realize the heaven has fallen. No doubt about it. And people started realizing that you've done everything. I think, in my view, when you communicate that to the team member, 2008, we always thought that we lose our jobs. And I'm sure we have seen people losing, manpower escalation happening because of the pressure points. But if the journey is beautiful, it gives confidence, makes you positive, leading to great mindset. I think half the victory of people in the team, etc., is won there, in my view. First thing first, many places you feel there is a gap there. I think once you can do that well, I think it does that. Second thing, even in the toughest part of cycles, economic cycles, continuous involvement of team, making them updated regularly about what's going on in the economic cycles within the corporate or outside world, within the industry, letting them know where are we heading. And there can be scenario analysis done that, look, if this happens, this can happen. Second scenario is this, third scenario it is. This all can happen, and this can lead to these scenarios within the corporate. I think once you explain that well, I think uh, team will be like symphony show. We're all of us are in sync, if you like that. They will not be misaligned. I will not name, but I've gone through such torrid periods in my career where the team continue to remain stable and stickier. Nothing happened to them. Second thing, uh, irrespective of economic cycles, it's about what you communicate. In my view, communication can be a barrier, and communication can also be the best tool for anybody to get confidence on. And I've seen communication builds the relationship and shakes the relationship, but how to inform them, how to communicate that, what do you explain it to them, how how do you monitor them react to those information or situation? I think that's the whole game. Third thing, what one we should remind people and the team, and this I've learned with experience, though I've never incurred that, but I've seen and I've been telling this vocally on stage and in every forum, that saving cost of fund is what makes your life. People pay, we say penny saved is penny earned, right? We always say the cliched statement, housing loan interest. Can you reduce that cost? When housing loan interest is going down, is your housing loan interest, can it be more rationalized? Can you get a better housing loan? Maybe you can switch. Think about it, that saves cost. Credit card interest payments. Today's youngster use credit cards and they are ready to pay 1.5%, 2%, 3% of interest rate. Why? Higher cost of NBFC loan, a lot of people take it because they are not capable to take loan maybe from a scheduled commercial bank or something like that. So they go for NBFCs and try and play on the LTV, etc. Also. Taking credit beyond servicing capability puts you under pressure. Today's youngsters, they are neck deep in leverage situation because they buy stock goes down, they lever, and then they are given investment. So Robinhood behavior in the market, stock market, F&O, etc., what we have seen, I think it's important for them to sort of be made. If all of us as responsible seniors can teach them, impart them with knowledge, etc., I think that is what will make them a very important person, because that will give them confidence and motivation. I know these are hard lessons which I'm talking about. It's difficult for a 27-year-old or a 30-year-old person to understand, but it's at least our responsibility to at least keep on drilling down in their minds, because in Hindi you say, no, manzil usko milti hai jinke hauslon mein jaan hoti hai. I keep saying this, and I think that's where they have to learn for sure. Yeah.
Perfect, Sanjay. I think on a lighter note, you can definitely write a book on Gen Z investment pattern, right? I mean, the kind of mistakes they're doing and what they can leverage on the experiences which leaders like you have. But I think if I summarize what you mentioned about this, it's all about, you mentioned the statement, what's in it for me?
Yeah.
And just to build on what Muskan said earlier, having losses is equally important to learn the art of investing. Same way, I think these downturns or these low points in the business cycle as well is equally important to kind of like look into the aspects which you normally ignore when there is a growth. Yeah, there's a saying that when the sea is rough, the fishermen focus on, harnessing or sharpening their fishing net. I think that applies to our business cycle as well, to look into the efficiency and to look into those aspects which we normally ignore. That applies to our life as well. So thanks for sharing that perspective,
Sure.
Sanjay. Staying on the people aspect, Muskan, I think we all have faced this similar situation, and as leaders in our own domain, where financial logic conflicts with human empathy, and we often have to make decisions which make financial sense, but emotionally difficult for people. What has been your experience, which you've seen in the industry, wherein how do you balance and navigate the tension between data and empathy?
Yeah. I think, Anil, these two words, financial logic and human empathy, these two words are very, very tricky, and very sensitive as well. I mean, being in an industry, it really, I think every finance leader encounters that tension at some point of time in their career, I believe. Because, number gives you clarity, but they don't always capture the human side of an emotion. So let's say if we talk about cost cutting, when a finance decision, affects people, it can be tricky to balance the money logic with kindness. I mean, imagine having to save money by cutting jobs. It makes sense financially, but it's really hard for the people who loses the work. So I think the best way to handle this is to think about both the numbers and the feelings involved. I mean, I may sound very, very, diplomatic over here, but that's the harsh reality, I think, which everybody and everyone has to accept that, right? Because to make your organization grow, sometime it's very important as well to take that hard decision, right? But at the same time, it's very important to be empathetic as well towards the people. You can do the bad stuff, but at least in a positive way, and or at least in a balanced way. So I think we should talk, openly with those affected. We should listen to their concerns and try to find solution that helps everyone as much as possible. So maybe so one way is that we can plan this all cost cutting or whatever. I mean, we can plan ahead so we are prepared for the surprises. This way you make smart money choices that also respect and understand people's need and worries. So I think, as Sanjay has also mentioned in the earlier question as well, that communication can be a barrier as well. Can communication, can be a facilitator as well. So it's just how you want to communicate the thing to your employees who are working day and day out for your organization. So I think being fair and clear helps build trust and better outcomes for everyone in the industry. And this means using both your head and your heart while making the financial decisions. Obviously, it's not an easy one, but yeah, you need to be a bit empathetic enough as well to communicate it properly to your employees.
Yeah. No, I think totally resonate with that, Muskan, what you mentioned. I think it's important for leaders to see that that's not an easy catch, that taking people action, because it has an implication. Yeah, I think it's all about having that finance leadership which moves
Yeah.
from numbers to judgment and judgment with empathy. So thanks for putting that perspective there.
But can I add something, because that's interesting point which you touched, Anil. Uh, we always use the word professionalism. Okay. Extreme professionalism, like we see in the global world, maybe in many companies worldwide. We always used to hear hire and fire long back, and all that. There's no empathy, etc., and all that. Organization first, and all that. I think what Muskan is mentioning is Indianized way of looking at it. That it's important to have a human empathy as well. Financial logic does make sense, but finally, human empathy is, because they are the assets finally for the company, right? I think that makes a big logic for sure. So I completely resonated.
Yeah. All right, great. I think we are almost on the top of the hour. So maybe Faisal, I invite you to see if there are any questions from the participants. And yeah,
Yeah, there are. We have received two questions from Neha and Nidhi. If you can see the chat window, you can take it up from there.
sure. Yeah. All right. So this one is coming from Neha. And her question is, how can one manage risk effectively when balancing immediate returns with future goals? Maybe Sanjay, I'll ask it to you.
Uh, I'll go back to Neha in saying that risk management is a phenomena which is dynamic in nature. It is not a one-day process for sure, because your broad financial planning is what makes your portfolio look better. Instead of looking at short-term returns, short-term goals, etc., and achieving that, uh, obviously, when the curve is steep, which means that when you take a lesser most of risk, you'll have a lesser most of return. Okay. And when you keep going up, obviously with the risk appetite, horizon, and asset class changing, I think your return always on changes also on that. So it's important for you to sort of look at risk minutely, very important. Look at how liquidity is locked. That's important for you. And what is the premium are you paying for getting for that liquidity if you're locking it? And if you're not, what's vice versa to that as well? In the financial planning management, I think whatever we are doing, whichever asset class you're looking at it, uh, whatever might happen, even in the worst phase, as I mentioned earlier, you don't sell gold, right? You don't. You don't easily sell gold. You actually hold it, maybe leverage it. You'll again try to retrieve it back from the lender. But that's where opportunity is from a financial planning point of view. Do not do not ever look at medium and long term investments. At least don't look at short term. The risk management need to be done very carefully, uh, articulated, understood, and then implemented. Short term, you can always have liquidity management done. That's absolutely okay. I mean, there, if you're compromising on the returns also, that's perfectly okay. Keep the liquidity in hand. That's important. Short term expenses taken care. But to me, one thing I want to mention to close this answer, reinvestment risk is the biggest risk, if nothing else. And if once you learned that, your portfolio is always be supportive to you. I don't know if that answers Neha's question. I don't know if Anil or Muskan want to add anything to that. Yeah.
I need to have a crash course with you, Sanjay, to learn more about that reinvestment is the biggest risk. So, but I think thanks for sharing that perspective. I mean, feel free to ask a follow-up if you have any on the chat. We'll be happy to take it further. But let me go to Nidhi's question. So Nidhi is asking, how do global uncertainties like inflation, interest rate fluctuation, or geopolitical shift impact this balance? Maybe, Muskan, let's start with you, and then Sanjay, feel free to add your perspective as well.
Yeah, sure, Anil. So I think global uncertainties such as your inflation, interest rate fluctuation, and geopolitical shift significantly influence the balance between the short-term pressures and the long-term priorities. Right. See, in the short term, these factors can create immediate operational challenges like rising inflation and interest rate might increase the cost and constrain liquidity, while your geopolitical disruptions threaten the supply chains and the market stability. See, so organizations are thus often forced to make reactive decisions to safeguard, I think, financial stability and operational continuity. Over the long term, persistent uncertainty shapes strategic plannings and capital allocation. So I think inflation and interest rate trends affect your investment returns and your funding strategies, while geopolitical developments can redefine your market opportunities and the risk exposure. So I think this creates a continuous tension between, managing the immediate risk and pursuing the sustainable growth. So again, the effective decision making under uncertainty requires organization to integrate the risk assessment with the strategic planning, strategic forecast, using tools like scenario planning analysis. We can do the sensitivity analysis to maintain the alignment between these two objectives, because this is a very sensitive area to look on, and very sensitive factors, which can affect the industry and the organization overall.
So let me add, to what Muskan is mentioning, and that's completely from a corporate angle. Absolutely, I'm aligned to her. Uh, See, we have seen multiple economic cycles. We have seen disruptions, uh, a lot of them in last, say, 30, 40 years, for sure. Uh, Today also what we are seeing, I think this is a very different fight and conundrum building. This joker in the pack may be Forex, okay, which we don't know. Okay, joker in the pack can be Japanese interest rate scenario moving up. We have never seen this expensive cost of Japan. We have never seen in a long period of time. Last 20, 30 years, we have not seen 0.5% interest rate in Japan. This was the market where yen carry trade used to always happen, and whole world used to thrive on that zero cost money from Japan moving across the world in equity markets and keeping it afloat and leveraged, however it is. Uh, there are many things which might unfold from here. There are many things which will come up from here onwards in front of our eyes. I think what we have to see is we have to hold and sustain ourselves first. Sustainability instead of looking at a pure growth point of view. I think that is what will make us stronger right now. When I speak to so many corporates and CFOs like Anil, I meet so many people, they are very critically conscious that in the world of AI, in the world of technology, in the world of disruption, and in the world of so many uncertainty, it's important that you sustain first, then look for growth. In my view, uh, India is poised far better for sure. India is decently better in terms of size, scale. In last 30, 40 years of time, there has never been a better technical fundamentals in our favor. Whether you talk about fiscal, you talk about forex, you talk about reserves, you talk about inflation, you talk about interest rate, you talk about currency pressure, you talk about size of scale. Did you ever think that India's bank can be fourth, fifth largest in the world in terms of market cap? Did you ever think that? And consolidation, we have seen all that. And the cost of money is lowest ever. Inflation is lowest in last 30, 40, 50 years. We have never seen, which means that India is on a cusp of that situation where if we hold our fort right, I think manufacturing growth, etc., can actually take off going forward. And I think that is where things will change. In our view, sustain and grow, because first you invest, then you look at return of investment, and then you look at return on investments. So don't forget that all three are very important, but all three are equally have a great weightage. Yeah.
Great. Thanks, Sanjay and Muskan, sharing perspective on this one. I mean, 2 cents from my side. While maybe the question which you ask is about how this impact the balance, but clearly, as Sanjay explained and Muskan explained, that this impacts. And the probably I'll talk for 30 seconds on the response. With this whole VUCA world, whether we call it VUCA, we call it BANI, the reality is uncertainty is the new normal. It is going to remain like this. The intensity may vary. But as leaders in our respective organization or as a professional, how do we respond to that? How do we take this as an opportunity? I'll give you very, very simple example, very recent example, GST implementation. 3rd of September, Government of India announced that, look, 22nd of September onwards, we will have all the rates being reduced. And within corporate, there was, and I'll say within CFO group, there was a bit of panic that how do we do that? System implementation, logistic challenges, existing inventory, labeling, and those kind of stuff. And for initial few days, we were not having the full clarity on. By the time we got clarity, we were only left with 10 days. And we got to implement it because that was a guidance which came across or a mandate which came across. So that require us to think differently, that what is something which needs to be done and how we can come out of this situation. While this was a short-term pain and we did everything to make us ready and we successfully implemented that, in long term, this is something which is going to be beneficial for everyone across the country. For almost every sector, this is going to get benefited on. So the uncertainty, whether it is inflation, whether it is interest rate, whether it's geopolitical shift, it's important for us to see how do we respond to that and what's in our control, what's in a sphere of control and sphere of concern. But the underlying fact is that new normal is that uncertainty continue to exist there. All right. I think we can keep going on, Sanjay and Muskan. It doesn't feel like that I am kind of like hosting this panel, but it's like more a conversation. So I really love that, but I'm cautious of time also. Faisal, I don't know how much time we have. I do see one more question, but I'll leave it to take it
Yeah,
forward.
we can take that and then we can close.
Right. So we have one question from Peter San. And the question is, can financial freedom and impulsive buying ever coexist? Or is it just a wishful thinking? And Sanjay, you talked about a lot of those mistakes which the Gen Z is doing. Maybe I'll start with you on this.
When I go and meet people and people buy Armani jeans on EMIs, no, always get scared anyway. Okay. So for me, that worries me the most. So I don't know whether financial freedom ever exists. But leverage positions definitely exist. That I can promisingly tell you. For me, leverage always jeopardize anything which comes to your mind. In my view, I think one should be cognizant of the fact that cost of money actually takes away everything from you. And that's what I want people to learn, uh, because buying a 1,50,000 rupees iPhone Pro 17 Pro, and great phone, no question about it. But buying an Armani jeans, who doesn't want to have it? But question is, when you join an organization, you don't need to have a four-wheeler. Okay, you can survive for some time before you save some money, spend some money, party a bit, doesn't matter. But question is, don't waste your money, because I always say rich dad, poor dad. Keep reading that book, and I'm sure you'll get a lot of answers from there. It's important that you remain conscious about it, because you will realize it after 10, 15 years, not now, when it leads to some assets getting accrued. You will actually make it about it. So I think that's where I will look at it. Yeah, maybe Muskan want to add anything.
I mean, I want to say that I resonate completely with Sanjay on this, but I think just to make Peterson feel better, I can maybe modify the answer is that in a way that you can have this wishful thinking. So I mean, I think that they can coexist, but under disciplined conditions. So when financial freedom is about having control over your money, ensuring your needs and long-term goals are secured, while impulsive buying is often spontaneous and emotional. So, but I feel that if a person has built a strong financial foundation, the emergency funds are there, the investment is there, the clear budgets are available, they can allow occasional impulsive purchases. That's what I felt. So, in that sense, it's not about wishful thinking, it's about prioritizing your long-term stability first and then enjoying discretionary spending consciously and very tactfully. So I think that's how you can manage again the balance between these two.
Anil, I was very conscious while talking about impulsive buying not to happen, because Zepto was talking, So
Yeah, that's why I wanted to give a mixed answer.
Yeah. All right, perfect. I think we are almost at the end. So thank you, Sanjay and Muskan, for those honest and insightful perspective. I think clearly I got a few takeaways and few jargons, which I need to connect with you separately to take it forward. And also thanks to everyone who has been patiently listening and for the engagement you drove. If I were to leave with one thought, I think that would be balancing short term and long term is not about compromise. It's about clarity. Clarity of purpose, clarity of priority, clarity of, in the organization setup is clarity of partnership as well between finance and HR. Because when we align numbers with purpose, performance with people, and then we build the organization, then don't just perform for the quarter, for the short term, but have that endurance for the decades. With that, thank you everyone, and a big round of applause for our panelists, Muskan and Sanjay, for such a candid
Thank you.
discussion.
Thank you, Sanjay.
I'll pass it back to Faisal.
Thank
Thank you
you.
so much.
Thank you, Mr. Anil, for skillfully steering the discussion and ensuring a seamless flow of ideas and engagement. Thank you to our esteemed panelists. Your diverse perspective and real world experience truly enriched today's discussion and gave our audience a lot to reflect upon. For those eager to learn and grow, the recording of today's session is available on our YouTube link shared in the chat window. Thank you to all our participants for being part of this session. Your presence made the discussion even more meaningful. We look forward to welcoming you to our next session on the topic AI in finance from automation to intelligent forecasting on November 6, 2025. With that, we conclude today's webinar. Thank you for being part of this journey. Wishing you a very happy Diwali in advance. Take care and farewell for now. Thank you, dear speakers, once
Happy
again.
Diwali.
It's been a real pleasure.
Thank you so much.
Thank you, Anil, for
Thank you so
being
much.
such an
Thank you,
amazing
everyone.
moderator.
Thank you so
Thank you,
much.
everyone.
Great,
Bye.
Thank
great
you.
to hear
Bye.
everyone. Thank you so much. Yep. Okay.